Now for a look at the labor market. More Americans than expected filed first-time jobless claims last week. Our next guest says even though we're seeing fewer mass layoffs, we're still waiting for job creation to pick up. Scott Brown, chief economist at Raymond James Associates, is a Bloomberg Best economic forecaster. He joins us from St. Petersburg, Florida. Mr. Brown, welcome to Bloomberg's Bottom Line.
Nice to be with you, Mark.
As I mentioned, the Commerce Department today reporting more people applying for unemployment benefits, but companies are ordering equipment, meaning that business investment is going to continue to help the economic recovery. Is this going to mean more jobs?
Well, it should mean more jobs down the line, but I think there's a story here. Really a division between large firms and small firms. And the large firms, the corporations, you've seen a very good rebound in corporate profits. That increase in profits helps fuel business fixed investment. There was maybe some pent-up demand, particularly in technology, during the downturn, so that's been satisfied over the last year or so. But that increase in corporate profits doesn't necessarily mean that firms are going to go out and hire more people. In fact, one of the reasons that profits are up is that these firms have held the line on labor costs, meaning they haven't gone out and hired a lot of new workers.
Right.
They've forced their existing employees to work harder. So you're seeing pretty strong gains in productivity.
Right.
Now we normally look to the small, newer firms to really account for much of the job growth during an expansion, and credit is still pretty tight for those small firms. Mm-hmm. We're also finding that these smaller firms that do have good credit don't necessarily want to borrow right now. They don't want the additional financial obligations. Interest payments to make until they see an increase in demand for the goods and services they produce.
Well, it's
a little bit of a chicken and egg.
Is it unusual to see the numbers bounce around like this at this time of year?
Oh, the claims numbers, certainly. I mean, we normally see claims spiking higher at the start of the new year. Seasonal adjustment is very difficult. So, seeing a 30 or 40,000 swing week to week is really not that much of a surprise. We aren't really going to get a good steady read on jobless claims until we get into February at least.
Are economists the only ones who see that a recovery is underway? Because as the president was trying to say the other night in his State of the Union address, we're seeing Wall Street making gains, banks reporting record profits, but it doesn't seem to be translating either literally or figuratively to Main Street.
Well, it is pretty slow going. All along we expected this wasn't going to be your typical business cycle recovery from a financial crisis. They tend to be much more gradual. It takes a long time before a lot of the financial damage is repaired, before confidence is restored. And typically the labor market does lag in a recovery. We do expect to see the job creation machine picking up. But I started to mention this is a bit of a chicken and egg kind of question. You're going to see maybe some stronger spending growth. That stronger spending will lead to new hiring, and that new hiring will reinforce the spending. One of the most important things in the economic outlook, and at least in the first half of the year, is this reduction in payroll taxes. And I think if a lot of people go back and they look at their paychecks, they look at their take-home pay relative to what it was a year ago, they're going to find that it's substantially higher. Right. If you're a household making $70,000 a year, you're going to see about $120,000 or so, $120 extra per month.
Right.
And that's a big chunk of change for a typical household. And that means they can go out to dinner a little more often. They can buy more clothes, buy a new car, something like that.
Well, our economics editor Michael McKee was telling us just a few moments ago that total orders for durable goods fell 2.5%. The median forecast of 81 economists surveyed by Bloomberg projected a 1.5% increase in total orders. Was this all about demand for commercial aircraft, or were we seeing volatility someplace else?
Well, it is a headline story with the aircraft, and many economists have driven themselves nuts trying to match the Boeing orders with the government numbers. It's not unusual to see these things really pop around month to month, particularly in December. There's some accounting issues there. But if you throw out transportation, the orders in December were a bit mixed. Generally positive, non-defense capital goods orders up, and even the shipments are up for the quarter. Not quite at the same pace that we saw earlier in the year, but still very much positive at this point.
Well, some of the factors that economists cite for their optimism this year: the extension of the Bush tax cuts, a cut in Social Security taxes for workers, an increase in stock prices, and that olive branch that the Obama administration is now extending to business. Is this going to translate into the consumer gaining enough confidence to spend?
Well, not just the consumer, but also business executives as well, I think, are going to be more encouraged. And if you listen to the State of the Union address, I think the rhetoric certainly has changed. Obama has been, recognized that many businesses thought that he was anti-business. That may change over time, and it'd be maybe like the Clinton years, where there's a big shift back towards the middle,
right?
And the businesses will be more optimistic, consumers will be more optimistic. But that this is playing out largely as anticipated, that this was going to be a very gradual recovery, and it is picking up. When you look at GDP growth estimates for this year, you're looking at maybe 3.5%, which is pretty good, but it's not going to push the unemployment rate down a whole lot by the end of the year.
We have about 20 seconds. There are still concerns, as you know, home prices falling, energy prices rising, states digging themselves out of a mountain of debt, which is going to translate into layoffs and cuts to essential services. Just yesterday, the Fed said the economy isn't growing fast enough and still needs help from a second round of quantitative easing. How do you balance an economy that's edged away from the precipice to one whose growth is moving at a snail's pace?
Well, we still have a lot of headwinds in the near term. You mentioned the housing is still going to be an issue. The problem with state and local government budgets is a big problem, because we're seeing actual job losses at the state and local government level. Right. Normally we'd be adding about 20,000 jobs per month. We've been subtracting 20,000 jobs per month over the course of last year. That pace of decline in government jobs at the state and local level may end up doubling this year. So that's one more headwind. But, I think there's enough positive momentum that we can build going forward. All
right. Scott Brown, Chief Economist, Raymond James Associates, joining us from St. Petersburg. Thanks so much. Appreciate it.
My pleasure.